Welcome to Beyond the Stock Market, a Groundfloor production. I'm Brian Daly, your host and CEO of Groundfloor, a private market investing and lending platform with over $2 billion in volume. I've been challenging industry norms my entire career, and in 2013, I founded Groundfloor with Nick Bargava to make private market investing accessible, open, and transparent to all. This podcast features some of the brightest minds in finance. Each episode goes beyond the headlines to unlock and unpack the relationship between traditional finance, also known as TradFi, and new opportunities. Today's episode is an exciting one because we're diving into a new category of private market investing. And this is a partnership that I think is indicative of where the industry is heading. I'm super excited about this. Michael Schwartz joins us. He is Chief Administrative Officer at Hive Financial Assets. He brings over 2 decades of experience in consumer finance with leadership roles at companies, great Atlanta companies, by the way, like Green Sky and Cardlytics. We have a bunch of Cardlytics people at Groundfloor.
It's a good spot.
People
Good
who
company.
grew up there and were the beneficiaries. So thank you for that. And CompuCredit, which are all have all focused on scaling innovative financial platforms. Michael, great to have you on the show.
Great. Thanks so much for having me.
I'd love to start with the basics. For listeners who may not be familiar, what is Hive Financial Assets, and what role do you play in the broader credit ecosystem?
Yeah, great question. So we founded Hive Financial Assets in 2017, and we are a direct lending or private credit fund. And so what does that mean, right? There's a lot of private credit funds out there. Private credit is as broad as saying I like stocks, right? It can be big stocks, small stocks, international, small cap, large cap. What we do is very niche focused. So given my background in consumer lending and my 2 partners' background in consumer lending and technology, we've raised a $160 million fund, and we use that to finance non-bank lenders. Our edge is that unlike any other fund that I know of out there, we actually are able to control the unit level risk. So rather than working with a lender and saying, here's our covenants and send us a statement every month and we'll do a just borrowing basis, we're actually giving the lenders the ability to use our algorithm to make the lending decisions at the unit level, which I'm not sure that any other fund does that.
So you're kind of distributing the underwriting.
That's right.
In a way.
That's right.
So that you're more deeply embedded with them.
That's right.
That's pretty interesting. Now, when people hear that term private credit, which a lot of people who are not familiar with private credit before are hearing about it in the financial press a lot now. People, when they think about that, they often think of the big Wall Street names, the big institutional funds. Those are the ones that are in the headlines right now because they can't meet redemptions.
That's right.
Like people want their money back, and here are these behemoths of Wall Street.
That's right.
Will not give them their money back. And they point to the fine print and said, well, we told you that was a risk. So that's been interesting. But where does Hive fit into that landscape? So you're not that.
Right. Well,
so how do you fit into the landscape?
We are. So it's interesting. We're not that. Right. So think about it as like those like Venn diagrams we did in like 7th grade math, where you got like a circle here and a circle here and a circle. Like we cross over, we intersect on some level with traditional private credit. But I tell anyone who will listen, right, that we were private credit before it was sexy.
Right.
We were private credit, unfortunately, during sexy, and we're going to be private credit after like the headlines blow up, right?
Yes.
And a lot of those are blowing up largely to the structure of their fund, where they have a mismatch between liquidity and asset duration, right? It's not necessarily an issue with the fund, but it's an issue with kind of their structure. We are within that world, but as I said before, we're direct lending, right? So it is just a way for companies to get access to capital that, for a variety of reasons, may not feel comfortable going to Wall Street to get it, or may not be able to go to a bank. And for us, the reason why they come to us is, again, that edge, right? They can ultimately perform better with us using our capital because of how we deploy the capital.
A lot of how this started in the current sort of media frenzy around this was because of AI.
Yes.
And the risk to software companies.
Mm-hmm.
SaaS, which was the darling here in Atlanta. It's all investors. When I was trying to raise money for Groundfloor, investors just wanted to hear how this is or could become a SaaS company. I'm like, it's not a SaaS company. And it was pretty clear to me that at some point, the other shoe was going to drop.
Yeah.
And it has, right? Because now people realize that recurring revenue isn't permanently recurring revenue.
That's right.
And something like AI can threaten it. And, people are debating how overblown that may or may not be in the individual on a unit basis.
Right.
But you guys are doing something quite different from that. I mean, can you describe the part of private credit that you're in and how, do you think you're subject to some of those same issues in some way? I know you guys are using AI in really interesting ways in the company to your advantage.
Yes, exactly.
But can you talk about that a little bit?
So
and sort of what your edge is?
Yeah, so I'll take a step back. And so the companies that we finance are lending to middle America, right? So they're lending to folks who, and we all read the articles of people living paycheck to paycheck. It's hard to, if you don't live paycheck to paycheck, you can hear the words, but it's hard to imagine what that really is, right? So the use case for one of our lenders' borrowers is you make $75,000 a year, which is a nice income. You fill up
That's above the U.S. median.
That's well above, right? I think it's double the poverty rate, right? Which is, really, so it's not destitute, right?
Correct.
You fill up your tank of gas. Now it's even more expensive than ever, right?
Yep.
$85, $90 to fill up a 12-gallon tank. You go to Atlanta, you go to Publix. Where else you go to your regional grocery store? Maybe you're buying Publix brand cola instead of Coca-Cola, but you're fine. You're making ends meet. And then a week later, you take your kid to urgent care. You have a $500, for a broken wrist, you have a $500 deductible. And if you have a credit card, it's maxed out. You're not going to go to a bank for a $500 loan, especially one that's fast. So they find one of our lenders, right? Our lenders can underwrite the loan very quickly and fund that consumer oftentimes same day. And so how do we play in that space? Right? One, we're providing the capital to the lender. And two, it's our system, it's our algorithm that is allowing that lender to sift through hundreds of thousands of applications a day. I think today our lenders are seeing about 200,000 applications a day.
Wow.
Right? In 6 to 12 seconds, make the right credit decision and then deploy the capital to that consumer who really is in a time of need and needs that capital fairly quickly. So that's how you can't sift through that many applications. And I kind of went through it fast, but you can't sift through that many applications in 6 seconds without using AI, right? And so we never really talked about AI and machine learning automation because we were just focused on, let's just make a lot of money and have a good product for investors. And now it's interesting because nothing's really changed on our side, but we end up talking about it a lot more because that's kind of what people feel like they have to talk about. You read about these mass layoffs on Wall Street, and I'm not at those companies. I don't know for sure, but the CEOs always point to, we're letting go 20% of our staff because of AI investments. I think it's BS. I think they're letting go 20% of their staff because they overhired in 2021 post-recession, post-COVID, and now realize that they've got to trim the fat. And they're pointing to AI because Wall Street has an expectation. They're talking about AI, or they're investing in AI.
It looks like a win because look how we're harnessing a new thing. Yeah, that's always interesting to watch. So you sort of got to this about what your edge is and how you have this unique model of distributing underwriting to the lenders that are doing the lending. So they have the customer relationship, they have the pipeline to the customer, but you get to amortize the cost of all of this underwriting know-how and tech across all of these lenders, and they like it too, because it lets them focus on bringing in the business.
That's right.
And they're not also conflicted by underwriting
that's
you're
exactly
providing them the capability. I mean, so why haven't others figured this out, what you're doing? Like I think this is smart.
Yeah.
You've been at it for a while.
Yeah.
So what do you think it is that led you guys down this path to figure out this is the way to do it? Whereas I think your typical private credit fund, the one we read about, is operating in a more traditional way where they're a counterparty to somebody who is then a lender to companies or something. Like what led you to this insight and what is it about this market that kind of helped you build the model?
So a couple things, right? And so one is like dumb luck, right?
Sure.
I'm an operator at heart. I'm not this is my first time truly raising capital from LPs, right? I've done M&A work and raised capital from private equity funds, but not from Groundfloor or from high net worth individuals or family offices. And so I know the business, right? I understand the end consumer asset. When I was at CompuCredit, when I was at Green Sky, even to some extent at Cardlytics, I understand consumer lending, right? So when you think about Wall Street, right? You get very, very, very smart people, but they know the lending, the warehouse lending side of the
Right.
business, not the lending. So one is there's this expertise.
There is a difference between the unit lending. In
Yes.
our space, the analog or the example of that was Peer Street, which Andreessen Horowitz invested in. And everybody was excited because there was this marketplace, and they could. I don't think they did it the right way because they didn't distribute the underwriting the way that you are. But people get excited about these ideas when you can be an aggregator and then pump it out. The problem is you never get the unit experience.
That's right. That's exactly right.
Like your customers, but you're so deeply embedded in the customers, you're getting the benefit of that network. But it sounds to me like you're also getting unit level insight.
That's exactly right.
And it's like, it's easy to lend the money out. How do you get it back? And in real estate in particular, that's a big deal.
Yeah.
We went through many trials and tribulations. We're pretty good at getting it back now. But in the early days, as some of our early investors will attest, like they had to exercise some patience with us, and still do from some of those older vintages. But so how it sounds to me like you guys really have a handle on the unit level.
Yeah,
is that accurate?
That's right. And so that goes back to, we think about everything in unit margin, right? And so at the lender level, because if the lender is healthy at the unit margin, then everybody wins.
Yep.
Right? I want the lender to make a lot of money, right?
Right.
If the lender makes a lot of money, they're going to have a healthy portfolio. They're going to be able to service our debt to them, and I'm going to be able to
and the lenders actually retain an interest as well.
That's right.
So like they have an incentive to make sure it's good credit.
That's exactly right. So
Yeah.
so the lender, it's the lender's portfolio. I'm just I say I'm the dumb capital. I'm not really the dumb capital. I'm the intelligent capital. But
Sure.
Tell them the easy way to describe it, right? And so think of it us as just a cost of funds.
Yes.
Right. And so if the lender makes, let's say lender lends $1 and they make a quarter, right? After all defaults and after all expenses, the lender is limited on how much money they're allowed to take out contractually by us, right? But then out of that quarter, they take give us our cost of funds, and then they keep the remainder of that as their equity. They're allowed to take out a little bit, but they've got that. So when you think about the business, right, the more equity that lender has built up, right, if for some reason there was a hiccup in performance or an issue with cash flow, they just come out of their pocket, right, and pay us because that money's trapped in the company.
That gives you some cushion.
That's right,
too,
and that
protects them.
That's exactly right.
So you don't have the conflict between counterparties that could come up if it were down to the iron.
What I like to say is, like, it goes along the line of trust but verify. But I'd like to help people be honest, right? So you put the right handcuffs on people, and it's sort of like locks on bikes, right? You can probably break a walk on a bike if you want to, but it keeps an honest person honest.
More than one banker patiently put his arm around me, and in the early days of Groundfloor, and probably seemed like a nice guy. You don't want to go into this lending business, do you? Because there are people who find ways of defrauding lenders, right? And there are bad actors out there.
No, there is, and so you can have the contractual covenants, but at the end of the day, you still have to have the views into their business, right? Because there's still ways to be shady if you want to, right?
So when you described a use case that I think was pretty clear around a borrower who is living paycheck to paycheck. That's not a pejorative. That's just the reality for a lot of people, and faces a financial exigency and comes to one of your lenders in order to make ends meet in that time frame. Is that a typical use case? Is that the typical customer, or are there some other segments or kind of use cases that fit within this?
No, great question. So historically there's been four big use cases. They're almost all event driven, right? So it's auto emergency and need new tires, right? It's a medical emergency. My kid went to urgent care, broken wrist, and he'd have to copay. There's like appliance repair, dishwasher breaks or air conditioner breaks. And then there's kind of like this other bucket, and what is growing exponentially, very, very fast, is kind of the living expenses of it, right? And so it's funny. It depends on how you bucket it, right? Because maybe you're spending more money on living expenses, you end up needing it for an auto loan.
Right.
That's becoming the category that people are using for their because it's all a little bit of self-selection. We can see.
So your lenders, how many lenders are there?
There's 6 lenders in the platform today,
and they can all use all 4 of those.
So they're all separate. So we're not allocating the people. So the lenders have their own marketing departments.
Sure.
And so a consumer, think about like like lending tree back in the day.
Yep.
Where you apply for a loan and you see a bunch of different lenders and you choose
Yeah.
the one you want. They may apply for a loan and see all 6 of our lenders on there.
Oh,
But it's really the customer choosing, where they want to
got
get a
it.
loan.
Oh, so they'll come to you.
They'll come to
a
the
lot of
lender.
time. They'll come
not to Hive.
not to Hive.
Right.
That's what I thought. But they're sort of choosing what the use case is.
Yes. Yeah.
Right.
So they'll be, so you would apply for a loan, a $500 loan, and you'd select, there's a drop down box, right?
Yeah.
And you'd select, automotive repair. We then, because we, on behalf of our lenders, have real-time access into the bank account
Right.
to kind of verify and make sure everything's going on. We can then see what are they using it for.
Yeah.
And so we have a little bit of a hedge on what they say, right?
Okay.
But it's interesting because the use, and this ends up, and I don't think I'm giving you any secret sauce, right? Intent for what you're using a loan for does impact your ability to repay, or is a signal for your ability to repay.
What people say their intent is.
Yeah, or what they, yes. So let's
So
say,
you're looking to make sure their intent is what actually happened.
that's right. So
then
yes,
the intent, once verified, actually
that's right.
has a lot to do with can they and will they repay you.
That's exactly right. So I'm not making any judgments at all on people.
I want to spend on some luxury item or experience or whatever, concert tickets.
That's right.
Maybe not as good a risk as
So
tires.
all things equal, right? Exactly. All things equal. Let's say you have 2 identical people, same exact credit score, same income, same neighborhood they live in.
Yeah.
All things equal, one person wants to get $3,000, and $3,000 is more than we'll do for our lenders. But having kids, I know what braces cost.
Yeah.
$3,000 for braces, and the other one wants $3,000 to go on a trip to Vegas. 11 out of 10 times.
Vegas,
I'm gonna give the money.
Oh,
I'm
God.
gonna give the guy money to bet with, but I'm gonna give to the braces person every time.
Of course.
It's just so there is a little bit of that intent.
Yeah.
Right?
Yeah. Okay. And when you're lending this money out, can you give me a feeling for the what is the fund expecting in terms of, what's the rate on these loans? How long are they outstanding? What's the repayment like? And what's your sort of collection experience?
Yeah, no, that's a great question. So these are all lending to portfolios that focus on people who are paycheck to paycheck and have challenged credit, right? And so all of a sudden, a lot of people hear that and they hear like warning signs to go off, right? Flashing, and so it's interesting because we do play in this I would say dirty industry, right? But we are very, very focused on making sure that we work only with the nice guys in a dirty industry. And how do we do this, right? So one is
the lenders.
yes,
good operators.
Yes, good operators. So number one, and not just good operators run a business, but like ethical and moral, right? Because there's a lot of guys that aren't.
Well, there's an opportunity to take advantage of people.
100%.
Right.
So I'll give an example, and I'm painting with a broad brush here. So it's not all bad. Not everybody in payday is a bad actor. Not everybody in non is. But the idea of a payday loan, you're going to borrow $1,000 from me, and you're going to agree to pay me back, I don't know, making that $1,200 in 2 weeks, right? Well, the odds of you being able to pay back $1,200 in 2 weeks, having just borrowed $1,000 from me, probably pretty low, right? So I, as the lender, would say, that's okay, Brian. I'll give you a $1,200 loan now. We'll just roll it into a new loan. And now you're earning interest on $1,200. And that's how you get to like this predatory lending cycle of debt where $1,000 turns into like $6,000, right? We'll never be in that business.
Yeah.
There are great people in that business. I'm sure there are ethical people in that business. That's not for us.
Yeah.
Our business is simple interest installment loans, right? So it is, you borrow $500, and again, making up numbers, you agree to pay back $750 over the course of 12 months, paying every 2 weeks.
Okay.
So it comes out every paycheck, but you're limited, right? It looks like the amortization schedule looks like a car payment, right? It's this much principal, this much interest, and then beyond that, and this is also this is not what I'm about to say is normal. The second part is not industry standard. So if a customer pays off a loan early, it's like a credit card. They're paying off daily average balance on their loan, so they pay it off in a month. They're paying significantly less than the $750 they agreed to pay. If they struggle and they have the loan out for, let's say, 18 months, even though it's a 12-month term and they're supposed to pay $750, the lender has the legal right to continue to charge interest, right? So instead of $750, maybe you owe $1,000 or $1,200. Sure. We, in our agreements with our lenders, we forbid them from collecting more than what the customer contractually agreed to pay. So there are probably customers, if there's no customers watching that, who can get in the system, right? Keep going out and effectively reduce their APR in half. But we just think we're not a nonprofit, right? We want to make money,
right?
But we think that we're in a business to meet people where they are and help them get through a hard time.
Do you see a lot of repeat business?
Yes. So
because of that?
Because
Yeah.
so there's two reasons why we do this. One is I think it's just the right thing to do, right?
Sure.
The second is when this customer needs another loan, not if, but when, right?
Which they
Because
will.
if they have
Yep.
bad credit, it's going to take a while to build up new credit.
For sure.
So when they need another loan, if they had a good experience, they said, hey, and one of my lenders is called Explore Credit. When they need $500 again, I say, you know what? I had a great experience with Explore Credit. They're going to go to Explore Credit's website. So there's like no marketing dollars in that customer, right? You want your data. You've got great data on them already, so you can give them more money at a better term.
Yeah.
And it's just a win-win for everybody. So that is the beyond kind of ethical moral. That's like the business reason to
Yeah.
do
I
it,
mean,
though.
repeat borrowers who've repaid you before are likely to repay you again, and they build up track record.
That's exactly right. Exactly.
So that's interesting. So you mentioned this issue about rising gas prices.
Mm-hmm.
I can imagine for people living paycheck to paycheck, that's a very real problem.
Yep.
People have to drive to work and drive their kids around, and I mean, I can see that could be a really tough challenge for a lot of people. And this inflation, it's been around since COVID, is maybe coming back. How are you positioning the portfolio to weather sort of these macroeconomic challenges?
Yeah.
Like what do you see out there, and how are you guys thinking about that?
So we always that's like the ongoing thing, and so when we think about and part of the reason why I like this asset class so much is because the velocity of cash is so high, right? So I mentioned that a customer generally pays back every 2 weeks.
Every 2 weeks.
So
Yeah.
so if I make a loan, we're in April now. If I made a loan in February, or my lender made a loan they used our algorithm to underwrite in February. We're in mid-April. I have a good sense of was that a good bet or bad bet. I don't know how good a bet or how bad a bet.
Sure.
But I'm getting signal already, right? So you go back to the AI, right? The system is already adjusting for macroeconomic events, gasoline prices, microeconomic events. Amazon makes a layout. Is this customer working at Amazon or where are they? And so it's already making those adjustments in real time, so that it is the lending decisions that our lenders are making today are different than the lending decisions that were made in February. Now, maybe only at the margins,
Right.
but they have new information and new data, so they're continually looking at how does it optimize, how does it get better.
Is that the machine learning?
And that's the machine learning. That's right. Now, obviously, there's human oversight. The lenders own it, but that's kind of how generally it works. And then you think about like a longer tail. Right? These aren't 30-year mortgages.
Right.
It's not even a 5-year loan.
Right.
These are 3, 6, 9, 12-month loans. So the tail is very short. So even if we made a bad decision, or made a decision that maybe in light of
Well, if you
future unemployment,
you got offside zone rates somehow.
That's
or
right.
Something.
But you're only kind of stuck with that loan for a short period of time.
Yeah.
Right. So
I've always liked that about our market too. The two, as I got to know you guys, and we're going to talk about our partnership in a minute. As we got to know each other, I saw some similarities that I really liked.
Yeah.
One is the repeat borrower
that's right.
aspect of it, which we enjoy as
Mhm.
well. It turns out that good real estate investors need to borrow regularly.
That's right.
That's who you want.
Yeah.
So awesome repeat business. But then also this same sort of short duration
Mm-hmm.
is, like we're going back to the private credit funds that are lending to software businesses that are threatened by AI. Some of those are 7 or 10 year loans.
Yeah. How do you?
I don't know, man. Like 7 or 10 years in software companies is a really long
Yeah.
time.
It's an eternity.
That's wow. Interesting. So let's talk about our partnership.
Yep.
Some. So I'm excited about this. Like I said, can you walk us through from your perspective how our partnership came together and what made it a good fit for you guys?
Yeah, and it was very fortuitous, right? So there's I don't know if we're saying names, but there's someone at the company who I've known from a prior life.
Yeah.
And
One of our first guests on the podcast, I think our first guest, Robert Vargas.
yeah. So and Robert and I go back at least 5 years.
Yeah.
And just a great guy, right? And he reached out to me and said, "Hey, I'm with this firm, and we're back on it. I had never heard of it.
Sure.
Yes.
Yeah.
Sorry. But we're looking to, diversify into private credit and consumer private credit. Can we talk more about what you do?" Like he knew what I did, but I wanted to get more detail. And then you fast forward a little more, and it was just the way our product is structured, right? There's a finite term, there's a fixed return, right? So it functions like a bond, effectively, a very, very high yield bond, right? We're paying a nice rate, and we're giving quarterly liquidity, which is also very nice. It was attractive to the product, I think, and I'm speaking for you guys a little bit of the product what you wanted. And then you get to, and then I think this is the first time I met you. me and Robert and you and my partner JP went to lunch together. And it turned out you and
We had
JP,
a fun lunch.
and you and JP, yeah, and you and JP have a history together. I mean, a good history together,
Yeah.
right? And so I've always said it's just like when our lenders, I want them to be good actors, right? I want it just because you can operate. There's whenever I'm looking at any sort of partnership, it's like, does the deal work? Does the economic terms, do they make sense? Right? And then it's like, who are the people that I'm going to be living with,
Sure.
right? And are these people that have the same kind of moral and ethical, values that I have? Are they people that, shit goes sideways, we're going to figure out how to work it out,
Right.
As opposed to, running the other way as quickly as possible.
Yes.
And you just kind of have all of that with this partnership, which is why I'm so excited.
We
about
feel it too. Like that all checks out for us as well. And we're excited to be, when we first started the company, we didn't know what categories of a private market investing we'd go into. Nick and I had 26 different, potential substrates, if you will, for building the company. And we found our way into real estate, and then residential real estate, and then sort of this investment, debt for real estate loans, business purpose loans. But on the list was a whole bunch of categories within consumer and small business and the like. And so it's exciting for us to be at the stage now where we get to go back to the original mission and say, okay, what are the next verticals where we can play a role and open up these markets? Because now retail investors really want into these markets.
That's right.
I don't think they want into it the way that Wall Street has in mind for them. And when we met you guys, we're like, wait a minute, this is something that fits really, really well with what worked in our original core product that we grew to $300 million in assets under management, right? And so I think I'm really excited about it.
It is,
and we did our first offering and sold out.
Yeah,
and I think it was oversubscribed in 12 days or something. So that was pretty good.
Well, one of the cool things, and also just from a size standpoint that works, is that, and I don't think we've talked about kind of the number of 7% of American needs loans. We're at 160 million AUM, which is nice size fund, but it's good, it's small and big, right?
Right.
We're very small given sort of Wall Street comparisons.
Yeah.
We're big compared to a lot of Atlanta firms, I would say.
Sure.
But we're never have to grow. Right. So we want to grow because there's tremendous opportunity. So we find partners like you guys that say, hey, we can give you X or we can give you Y. And it just sort of depends on what the timing is. And so that also works really well.
Yeah. I think that's good alignment. Okay. So as we've done with a bunch of these episodes now, we're ending with a round of rapid fire questions. I'm pretty sure you had these before, but if not, I apologize. So answer each of these questions, if you would, with the first thing that comes to mind.
Okay.
Don't have to go. You can expound if you want to, but you don't have to. And there are 6 or 7 or 8 of these. Okay. Number 1, one word to describe today's credit environment.
I'd say opportunistic, and only because I think it's also crazy. But if I had a ton of cash, just personal, I would go in a lot of free time. I would create a distressed private credit asset buyer, because all these companies have to unload assets that are perfectly fine assets, but they've got a mismatch, right? And they buy something on 65, 70 cents on the dollar, crush it.
I'm very interested as an investor in, I don't want to say exploiting. That's not the right word. Utilizing. Utilizing the liquidity discount.
Yes,
that's out
100%.
It's very interesting. Okay, so what's the biggest opportunity in private credit right now?
I think that's it. I think it is
the liquidity.
discount. Liquidity discount.
Yeah, I think so too. The biggest risk investors should be paying attention to.
It is investors in general, or investors from my fund?
I think just investors in general.
So
thinking about
unemployment.
Yeah. Okay.
Consumer spending drives our economy.
Yeah.
If unemployment increases tremendously, I think we're in trouble.
And we really haven't, COVID accepted for obvious reasons, but we really haven't over the relevant term since the GFC seen very high unemployment.
That's right.
We've lived in a really nice place there. So I think that's an interesting one to watch. I agree. Any favorite books or podcasts you listen to?
So I'm a history guy, right? And so I just read a book. Have you ever heard Eric Larson?
I think I've heard.
So he writes these books that they're history books, but he writes them. It's like a fiction. It's like a novel. So it's all primary sources, and he'll So they are actually like, it's history, but it's like dialogue, right?
Interesting.
And it does not feel like you're in some boring history class,
Yeah.
right? Listening to it. And so I just read one. He's got a couple books out. I just read one on the Blitz of London during World War II,
Yeah.
and it's about that year, right? In Churchill, and like what like he was going through and how they did it. And it reads like fiction, and it's like 100% like primary
It's real.
source.
That's
really
cool.
cool.
I love that. Some of us have long drives that we got to do this summer, so
right?
that's good to know for audiobooks.
Yeah.
And what advice would you give to someone who may be just starting out in the investing field?
So, like in terms of investing their own money or investing capital?
Sure. Like maybe they're thinking about doing this for their profession,
Yeah.
as you've done for a couple decades now. So
two things. I'm gonna cheat a little bit. One is patience, right? Be able to kind of take the long view. But the most important thing to me is Einstein described it as the eighth wonder of the world. It's the magic of compounding, right? Long view, reinvest the interest, and earn interest on interest is the greatest thing there is.
And that's
from
tough.
an investment
That's tough for
standpoint.
young people right now
Yeah.
because they've been trained in reflexivity and sort of buying the dip and, and making a fast profit. And,
We match up to a certain percent. We match our team's 401k contribution.
Yeah.
And we got a pretty big, there's about 50 people across the
Sure.
organization. I yell at people every quarter. Like, it's free. We're giving you free money.
It's
like,
free money.
take it.
It's
Take
extra
it.
comp.
And it just doesn't, people, for whatever reason, don't do it.
Wow. Well, someone will.
Someone will.
I did when I was a kid.
Yeah.
I was raised right as an investor. What is an investing habit or process you always try to follow?
So it's evolving over time with AI. I now have, with help my partner show me how to use it, but in my investing framework. So understand kind of what your framework is. And then I have applied, I put any deal I look at into that framework.
Got it.
And where does it fall within what so that way you sort of take your mind out of like a sexy deal.
Yep.
Right? Is this the new AI company that like everybody's talking about? Or is it, like tractors and trailers? Like, it doesn't matter. I mean,
Right.
maybe there's some industry side of it, but you know your framework, and does it fit that box? And
Yeah.
so I've always had the framework, and now AI has actually like accelerated that and give me cool reports about like,
It's a stronger, more robust, interactive
That's right.
framework.
That's right.
That's cool. And then one more question: if you weren't in fintech, what would you be?
So we touched on
Doing.
I would be a high school history teacher, and maybe I may get that back to that one day.
Yeah, that's fun. That's a good one. Well, Michael, this has been a great conversation. We're really excited about what you're doing at Hive. I'm excited we're working together. What it represents for us, as I said, is a partnership that helps us as Groundfloor deliver on the promise that we envisioned 13 years ago. I think retail investors are going to love your products and investing with you guys. I'm excited to have it on the platform. So thank you for engaging in it. For our audience, you can connect with Michael via his LinkedIn, which we'll include in the show notes. You can also learn more about Hive at hivefinancialassets.com. And please be on the lookout for new investment opportunities from Hive and Groundfloor that are coming soon. We've done one. There's another one coming. I know that, but I'm not at liberty to divulge when it is. But it's soon. Check out all episodes of the podcast and suggest a future guest for us at groundfloor.com/podcast. And please don't forget to like and subscribe wherever you tune in. Thanks again for joining us on Beyond the Stock Market.